Hello and good morning everybody. So as we talked about in this topic before, divisional performance measurement, we have talked about ROI in the previous videos, all the different ROIs and profit and all the bases, the cost base, revenue base. Now we're going to talk about residual income. Now what is a residual income? Residual income is one way to measure the performance of a division. It can give results that avoid behavioral problems of dysfunctionality. Wow. Okay, so in derivative measurement, instead of here, the center's profit is after deducting depreciation on capital equipment. The input cost of capital might be potential cost. So residual income is basically a measure of the center's profits after deducting a national or interest cost. Now that it's very self-explanatory. Center's profit after deducting a notional or imputed interest cost. So for instance, capital employed, division 400,000, ROI 22%, additional investment 50,000, nil receivable value, average net profit of this investment will be 12,000 after depreciation, and the cost of capital is 40%. So every time a question about residual income is all about trying to see whether we embark on the investment or not, because that's what management accountants do. We are supposed to calculate and we are supposed to measure the effectiveness of the division. So capital employed 400,000 earns around 22%, so therefore it gets 22% of the capital employed, so it will have 88,000 for before investment, and then we have to calculate the interest that we will be paying to which that cost of capital is 14%, so we will be paying for the parent company. So if it's 14%, so 40% times the 400,000 our capital employed, so we get 56,000, so therefore the residual income is 32,000. Now after investment, we have 400,000, however they want to make additional investment of 50,000, so we just take 450. So now we look at after investment. So the investment is 400,000, and then we get a ROI of 22%, so it's 88,000, and then with the new investment we will actually have average net profit would be 12,000, so we just take 88,000 and then we combine it with the 12,000, and then we get our 100,000 investment. So now we actually have to calculate our 100,000 profit. Now we have to calculate the COC, the amount that we have to pay to get this capital, in which that the 40%, so from 400,000, additional investment of 50,000, so 450,000, we times it for 14%, we will have to pay 63,000 to the company. So when it's 100,000 minus 63,000, 37,000. So you, as the divisional manager, would you take the investment? Yes, simply because it has an increase in residual income. So the advantages and weaknesses of residual income compared to ROI. Now we actually have to understand the advantages and disadvantages of. We actually have to understand the advantages and disadvantages of the residual income. And the advantages of residual income is that it will increase when investment earnings above the cost of capital undertaken and investment earnings below the cost of capital are eliminated. So residual income is more flexible since a different cost of capital can be applied to investment with different risks. Therefore, we can always use different COC, we can always use different WACC, we can always calculate a new one to cater to the amount of risk that we are embarking with the new investment. However, the weakness of residual income is that it does not facilitate comparisons between investment centers, nor does it relate to the size of center's income to the size of investment. So if the investment center is a 5 million base, we cannot compare the residual income with a base of 500,000. It is far too big of a difference. Therefore, it's not the same thing. We have to compare an apple with an apple. So a 5 million, we can only compare with another 5 million investment. We cannot compare with 500,000 or 200,000 investment. RI versus ROI, marginally profitable margin. So residual income will increase if a new investment is undertaken which earns a profit in excess of input interest charge. Therefore, if you were basing on residual income, even if we have a decrease in ROI, even if we have a decrease in efficiency, if it brings more profit to the company, more profit to the division, then the divisional manager will say yes to it. However, if we were to base it on ROI, when the manager is judged through IOR, they will most probably not take a higher profitable investment simply because it will increase the ROI significantly. So now let's look at this question. Department H. Department H. So profit assets employed impute 12% of interest. So operating profit is 30,000. Operating asset is 100,000. Imputed interest is 12% because 12% from the operating interest. 100,000 times with 12%, so it becomes 12,000. Return, the ROI is 30%, so 30% times with the operating asset. The operating asset, the capital employed is 30,000. So what is the residual income? Is when you take the operating asset, operating profit minus the imputed interest. That is all, and we got 18,000 residual income. So let's say additional 10,000 is proposed, which will increase the incomes department by 1,400. So the total operating asset is now 110,000, and the imputed interest is 12%. So we take total operating income, we divide it by the total operating assets, we will get a return on investment of 28.5%. However, the residual income is total operating income minus imputed asset equals to 18,1200. So if Department H is responsible for department's performance, they will not take the new investment simply because it will decrease the ROI to 28.5%. However, if you were to judge on the residual income and which is overall better for the company, it will actually take the investment simply because it will has an increase of 200 for our regional income and 1,400 increase of operating income. So that is all for the chapter. So if we click on the next video, then we will see the we'll do some examples for this particular topic. So that is all. Thank you for listening.